Hey everyone, this is Kirk here again at Option Alpha, the members only video update. So I wanted to send out this video earlier this morning, but as you guys saw in the email, Verizon wasn't acting favorably. So spent about 2.5 hours on the phone with them this morning, which really threw off my morning routine. So I didn't get a chance to get this video out this morning like I would have liked to, and maybe given some people a possibility to get into a different kind of trade. But I'm going to get it out now, and it's something that I just wanted to share with you guys as another trading opportunity in the market, something to take a look at. It's obviously it doesn't have to be something that you always use or always look at in the market, but I think it's a really good volatility play on the VIX. It's something that I've been trying for the last couple of months, and I think that it's been working fairly good. And so I wanted to share something, a new strategy with you guys. So again, this is just for you guys. This isn't for the public, so I won't send this video out to anybody else. So another perk to the membership here. So before we begin, just taking a look at the indexes over the last couple of days. Obviously, like I said in the beginning of the week, God bless day traders for even trying in here, because it's just been a whipsaw action every day. Hard pressed to say that this wasn't coming, though, because if you start to look back at the some of the momentum indicators like MACD and stochastics and RSI, they all topped out pretty much in the first week of October and have since started to decline considerably since then. And even today, even as the market rallied, we still had declining momentum. And we really got that bearish cross on MACD in the beginning of November. And when I sent out a video, I said, look, it's a bearish cross. It is what it is. The market looks like it's making highs, but we could start to see some sell-off. And I think that that's what we're starting to see now. So obviously, as always, it could go any direction. And to a large extent, the government and most of the central bankers are going to have a big play in what happens. But most of the momentum indicators are still showing that we're definitely heading lower. So as far as the Dow is concerned, we had a really strong type of a base here. We're sitting at really good support now at 11,750. So if we break that level, then I think 11,250 is going to be the next major area of support. I think we'll make a run down for that pretty significantly, or just very, very quickly over a course of a day or two. Maybe even not, maybe even a couple hours, who knows. But really the next hard level of support isn't really until 1125. And you can see even back here at around 11,350, that was a pretty good area of resistance going back there. So that's going to be the first area of support as we head lower. Okay, so on to this volatility strategy. So the volatility strategy really involves the VIX, and just mainly the VIX. And most of you know you can trade VIX options. At VIX is the ticker symbol for those. So they're cash secured, and cash settlement. But I think it's a really good strategy in the current market that we have, where we do have periods of spiking volatility, like we've seen in May of last year, more recently in August, and pretty much lasted throughout October. But a good way to play this is with a back spread or a ratio spread, which way you want to call it. And I think this is a really unique way to play volatility. Volatility tends to be drawn lower as the markets calm down. So these spikes in volatility, while they can be very painful if you are selling options like we are in credit spreads, etc., they can also present a good opportunity for you to make money as volatility drops. The one thing we do want to consider, as always with volatility, is that in the times that we've had this volatility go up to 45, 50, etc., there are instances where volatility has continued to move higher, namely 2008, and it's breached the upper 90s and stayed up there for the better part of really 4.5, 5 months. So we do want to consider that risk when we start to build this strategy. So I've built a simulated strategy, and I just want to share with you guys. Again, this is just an example of what you can do, but these numbers will really start to work. They work pretty good now anyway, but they will really start to work a lot better once volatility starts cracking in the 40 type range. So we're going to go over here to the Analyze tab on my Thinkorswim platform, and all I've done is add some simulated trades in the volatility screen. So you can see I've typed in VIX, I've gone down to the December options, and I've just added a couple strategies here. So I'm looking at my risk profile now, as far as the different positions that I've added to this particular Analyze tab. And what I've added here is I've actually added a bear put spread. And so I'm going to buy the 37.50 put, and then I'm going to go right back in and sell the 35 put for December on the VIX. Now this is going to create a debit because I want the market to actually go lower. So this is really kind of the opposite of a credit spread, is that we're at, or credit spread above the market where we want the market to stay lower. We actually want the market to go down. So this is going to be a put driven spread as opposed to a call spread, which we would typically make and then take in the premium. So the debit for that is about $195. Then what I'm also going to do is buy another out of the money option. So again, you can see it's not really an exact ratio spread where you would buy an additional 35 put or an additional 37.50 put. But I'm buying one all the way out here at 65, and that's because it's a little bit cheaper. It's only 40 cents today. So it's only $40, making our total investment about $235 in this exact position. But what that also does is gives me a lot of volatility exposure. So if the VIX does continue to move higher and move higher in a dramatic fashion, then you can see this red line here shows my profit as VIX moves higher. Now this red line is going to start creeping every day slowly closer to the break-even levels at expiration, but at that point, if volatility is so calm that it's really not moving anywhere, it's going to be moving down. Volatility is either moving up or it's starting to retrace back lower. So what I've done by adding this one simple 65 call here is that I've exposed myself to a lot of vega in the portfolio, or a lot of good positive volatility. So if volatility goes down, we have an option to make some money on this position. But if volatility really goes crazy and haywire, then we also have an option to close out the position early and take advantage of that huge volatility spike. So that's what we've done by building this position. Again, you don't want to let the market or the VIX move up high and then just stay there. You want to take advantage of it if it does move higher, close out the position early, and sell back that volatility to the market, to somebody else. You want to profit from that. Now, where the strategy really gets interesting, though, is in the basis of what I built in this strategy, and that is that we do want the VIX to go down. We want calm volatility. The hedge with a 65 call is just simply that. It's just simply a hedge. But if we actually play the position like it's built, and that is a bear put spread, then we'll make about $15 per strategy on this trade if volatility calms down. Again, it's just got to close anywhere below 35 to us to start to make money at expiration. So the lower volatility goes, the more things calm down, the better for this position. So you can see why it's a really good position to enter during periods of high volatility where we could start to see volatility decline and decrease. But then again, we added a hedge just in case it doesn't. So this is the overall strategy. Like I said, it's about $235 to enter the complete strategy with the hedge. And you make money about $15 if the market moves down. It's a little over a 6% return. So again, it doesn't seem like a lot of money, $15 per $235 investment, but that's really good returns if you can do this on a consistent basis. Even if you do this 2 or 3 times a year, you're looking at double-digit returns for your portfolio. So I hope this was helpful as far as the strategy, a quick tip for you guys to learn. So as always, I welcome your guys' comments and feedback, and happy trading.